Stocks or bonds? What do you want to own right now as we head into the next couple of weeks of the markets? That's coming right up on 3 minutes. I'm writing an article right now for the website, which will be out later this week, talking about stocks and bonds, interest rates. Does it matter to stocks when interest rates go up or down? Interestingly enough, doing the analysis, prior to 2000, before the Fed became extremely active in the markets, interest rates had a negative correlation to the direction and trend of asset prices over time. In other words, when interest rates were going up, stock prices were going down, and vice versa. Interestingly enough, though, following 2000, and particularly after the financial crisis, stocks and bonds are now highly correlated. In other words, when interest rates are going up, stock prices are going up. When interest rates are going down, well, so are stocks. Currently, that remains the condition right now. When we take a look at the stock market's been rallying nicely over the last couple of months, and this has actually been a fairly strong rally following that decline we had back in September. However, our money flow signals are in place, yet stocks are holding up near all-time highs. Take a look at interest rates. If we look back during that decline that we saw back in September, October, we saw interest rates falling, got very oversold here. As stocks have been going up as of late, so have interest rates. Now, interestingly enough, we're back on a buy signal for rates. That's a negative for bond prices, obviously, but that buy signal is starting to get a little bit elevated here, suggesting that we may be closer to a turn in rates in the short term to start to see rates fall lower. Now, this could come up for a couple of reasons. One, if we start to see a negative impact to economic growth because of higher rates of inflation, or if we begin to see an impact of a stock sell-off because of what's happening with mutual fund distributions coming up in the next couple of weeks, that's going to start to turn interest rates lower. So the real problem for investors is simply this. It used to be that owning stocks and bonds would provide lower volatility to portfolios. However, because of the now almost near identical correlation between stocks and bonds, it's now become a risk-on, risk-off event. In other words, I want to be all in stocks when the markets are going up, and when markets are correcting, I want to be all in bonds. That's a very difficult transaction to do, but the stock bond allocation is still providing some benefit of lower volatility while still providing performance to an actual portfolio. But the problem today for investors is this high correlation between stocks and bonds now makes it more difficult to manage portfolio risk than it was before. Again, what happens here over the next couple of weeks, I would expect to see some type of correction in the first couple of weeks of December. Normally the case, again, just a statistical normality as we head into the end of the year. And that would be a potential here to start to see rates go lower when that stock sell-off occurs. So again, maybe having a little bit of your portfolio in bonds might not be a bad idea if we are going to try to hedge against some type of correction in stocks short term. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. See you tomorrow.